So I booked a small loss on this stock. I wanted to show you this trade. This is ABB and this is the latest candle. And I bought and sold the stock on the same day. So let me explain what this trade is. Why did I take this trade? Where did I keep my stop loss? Why did I book the loss? Everything. So the blue line is the 50-day simple moving average. The green is the 150-day. The red is the 200-day simple moving average. So as you can see, it's a nice uptrending stock. You have the blue, the green, and the red. That is the combination I'm looking at. Next, the orange line is the 8-day exponential. The purple line is the 21-day exponential moving average. So it's a nice uptrending stock. And as you can see, it starts forming a base from here. So let me draw the points in the base so that you can understand what I am looking at here. So this is point number 1 in the base, the highest point here. Here, 1. Then the lowest point, 2. Then 3, the highest point again. Then 4, the highest point, lowest point again. Then 5. And then this candle, small. So those are my points on this base. So 0.1, 0.2, 0.3, 0.4, 0.5, 0.6. But if you look at this base, okay, if you look at this base properly, 0.1, 3, and 5, these are my buy points. This is where I plan to buy the stock. But 0.5 is in the lower half of the base. So that is why I decided to take a trade at 0.3. So let me remove this base. See, here you have 3 contractions. Contraction 1, contraction 2, contraction 3, which is great. After the stock begins to contract, the chances of it breaking out are very high, especially if it's an uptrending stock. This is nicely explained in the book written by Mark Minervini, who is my ultimate guru. So please read his 2 books, Think and Trade Like a Champion and Trade Like a Stock Market Wizard. This pattern is explained there. The name of this pattern is called volatility contraction pattern. So let me remove this. So I took a trade on the high of this candle. That is where I was planning to buy the stock. So that is 6569.80. So let me draw the, wait. The high of this candle is 6569.80. Yes. So the yellow line is where I plan to buy the stock. Now, if you see here, on this day, I was trying to execute the trade on the 15-minute chart. So let us go to the 15-minute chart. So if I go to the 15-minute chart, I'm waiting for a close above the yellow line. So as you can see, this is the latest day. So this closed above the yellow line. But the problem here is majority of the body of the candle is below the yellow line. So instead of taking full position, I took half position. So my full position is normally 6.5, 6.25%, and half of that is 3.25%. So I took a 3.25% position size. So 3.25% of my portfolio was invested in this stock at the close of this candle. So my order got filled at 6604.65. The closing is 6601 of this candle, but my order got filled because I put a market order. It got filled at 6604.65. Wait. So let me draw that line for you, 6604.65. Let us give it blue color. Let's go to the daily time frame. So as you can see here, the yellow is where I plan to buy the stock, but blue is where I actually got the order fill. Okay. Now let's put the stop loss and the target. Stop loss is 8%, target is 16%, 2:1 reward to risk ratio. So my stop loss was at 6076. I have written down some notes here. So I'm taking the values from there. Just know that this is 8% distance and my target is 7661, which is 16% above the blue line. So blue line is my actual order fill. So from there, I will keep 8% down and 16% up. So if I minimize this, see, buy price, stop loss, target. Okay, that's my trade. So I took the entry and I waited for the entire day. I wanted to see good volume coming on that day. So if you see, the previous day volume was 158,000 shares. The next today's volume, the latest volume was 393. So almost double the previous day volume, but not enough. See, the volume is still below average. The blue line is the 50-day simple moving average of volume. So I have a day where the price is closing below the yellow line. That means it is not a breakout, it is a fake out. And the volume is below the blue line. So just 5 minutes before the market was closing, I completely exited the position because I did not get what I was expecting to get from the stock. What was I expecting? I was expecting a high volume breakout from the yellow line. So the volume should have been above the blue line and the price should have closed above this yellow line. In that case, I would have stayed in the stock. But this is a clear sign that there is no volume, which means the buyers are not coming. Uh, Price is closing below the yellow line, which means it could fall further. So instead of waiting for this stock to come down and close and take out my stop loss, why not just exit here? Okay, so that's exactly what I did. So let us calculate what was my loss on this trade. So position size is 3.25% and my loss is 1.04%. 1.04%. So let us do some calculations because this calculation is very important. So if I look at this, I took a 3.25% position size here, 3.25% position. And from here till here, my loss is 1.04%. So if I multiply that, I get 0.03%. This is the amount of loss. This is the amount of money I lost on a portfolio level. Okay. On a portfolio level, this is the amount of money that I had lost, 0.03%. So, which is not a big amount, which is a negligible amount, right? So I took my chance. I took my chance here. Okay, if this stock would have shot up, it would have shot up like 10, 15% because that is what happens with the uptrending stock. But booking 1.4% loss on a 3.25% position size is not a big deal. This loss could easily be covered. So this red color line, which is 8% stop loss, is just for emergency purpose. I am not going to allow the stock to come down and hit my stop loss. If the market is giving me early signs that there is no volume, the price is closing below yellow line, why should I stay in the stock? If I am not getting what I'm expecting from the market, I am not going to stick around. I am going to take a small loss. And this is a basic logic where if the price is not going in your favor, cut your position. And if the price is going in your favor, don't cut your position or even add to your position. This is basic logic that we as professional traders should use in the market. That is what I think. So anyways, that is what I wanted to discuss with you. I hope you understood this trade. Let me run through this trade again with you. So blue, green, red, 50-day, 150-day, 200-day, nice uptrend. Then you have a nice base building here. Now the stock closed below yellow line on low volume. That is why I had to sell the position. Now the next candle, if the high of the next candle is below the high of this current candle, then I have another opportunity to enter the stock, right? But because now it will complete 4 points. Let me show you that. So if I look at this, so this is 0.1, this is 0.2, this is 0.3. And if the next candle closes below like this, I'm expecting something like this to happen. So if the next candle's high is below the high of this latest candle, I am going to take a re-entry into the stock. Now, in that case, even if I have to book a small loss, I will book that loss because it is like 0.03% of my total portfolio, which is easily recoverable. So I hope you understood this trade. So a loss of around 1.04% on a position size of 3.25%, not a big deal. Anytime I see this trade, this kind of a setup, I will always take the trade because in such cases, my losses are very small. But if the stock shoots up, my profit is very large. So for example, last time I showed you this stock, Moil. If you see this, I bought it here. See, 0.1, 0.2, 0.3, 0.4, bought at the yellow line. Blue line is my fill, and it just shot up. Okay. Same story repeating. It's just that this stock has more candles than the previous stock, but the base structure is the same. It has got two contractions, 4 points in the base, the same setup basically, nothing different. Okay. One stock goes up, another stock comes down. We can't do anything about it. All we have to do is take the trade, see what happens. If the market is giving you a clue to exit, exit. If the market is giving you a clue to stay, stay. Then you'll hit your profit target. Not very difficult to achieve that. Okay. So this is my trade on ABB. So if you have any question on this trade, this is very similar to the trade that I took on Sangvi Movers. So let me show you that stock. I have made a video on this. You can check on my channel. So this is where I took. So see, this is where I took the trade. Forget about this candle. This is where I took the trade. 0.1, 0.2, 0.3, 0.4, and I took the trade. See, low volume. See, this is a mirror image of the previous trade of ABB I showed you. See, if I don't sell here, look what happens. The price has started to come down. It might break the 21-day exponential and hit the stop loss as well. Even here, it almost hit the stop loss. So now in ABB, I don't want that to happen. So the next candle could easily break my stop loss. So why do I want to put myself through that trouble? Why not book that 1% loss and leave from there? Because the trade on Moil has given me 16% return on 6.25% position. This is like 1% loss on 3% position. So do the math. You will see when I'm booking my losses, the loss is extremely small compared to the profit that I'm making. So I am making the mathematics work for me. This is not about chart or trade or pattern or anything, moving averages, indicators, nothing. I am trading with mathematics in my favor. I am trading with odds in my favor. Okay. So I hope you understood this trade. If you have any questions, comment box. Okay. Thank you so much.